Welcome, I'm Ross Bramwell and thanks for joining this Investment Insight. In last month's video, I talked about the importance of earnings expectations for the second half of this year. Currently, estimates are still forecasting for a decline of over 6% year over year for the second quarter earnings estimates. As we just began the second quarter's reporting season for earnings just last week, let's take a minute to discuss how the stock market has reacted so far to the earnings expectations this year. Here we have a chart that shows the S&P 500 return year to date in maroon, up around 17%, as well as earning expectations for 2024 here in the tan line, with each being indexed to 100 to start the year. Expectations for 2024 S&P 500 operating earnings have fallen from $253 per share at the beginning of the year to around $244 today. While this is only a modest decline, it means that the S&P 500's entire price gain year to date has been due to price to earnings multiple expansion, meaning investors have been willing to pay more for stocks as evidenced by the S&P 500's price return year to date, even though estimated earnings in the future have declined. This would have been easier to understand when the 10-year Treasury yield hit its lowest level of 2023 at roughly 3.3% back in early April, but it's harder to justify now as the 10-year Treasury yield recently broke above 4% in recent weeks. A combination of slower expected earnings growth and higher long-term interest rates have not historically been consistent with multiple expansion or the continued outperformance of long-duration stocks, which are typically growth-oriented stocks. A slowdown in the economy in the second half of the year may ease the pressure on the long end of the yield curve with its interest rates. We believe the Fed is going to stay aggressive and is likely to maintain rates at peak levels after it pauses on additional rate hikes. Markets are finally getting on board with the Fed's messaging and are now not pricing in a rate cut until next year. Rates are currently in what we would call restrictive territory, meaning that rates are at levels that should lead to a contraction or slowdown in economic activity. And we believe the Fed will maintain rates in restrictive territory for quite some time still. The Treasury issuance is set to increase significantly in the near term, simply based on interest expense alone, which will keep pressure on interest rates. In this chart, we show price to earnings multiples for the 11 S&P 500 sectors as well as the aggregate S&P 500 here on the far right. And we're looking at the maroon line is the PE multiple as of January 2023, and the tan line is as of last week here in July 2023. Multiple expansion has been largely driven by large cap growth stocks in the discretionary and then also the technology sectors here highlighted in the red circles. But multiples have expanded in 8 of the 11 S&P 500 sectors year to date. And for the S&P 500 in aggregate, even as S&P 500 earnings expectations for 2024 have declined throughout this year, as we just discussed. Last week, we received more good news on the inflation front as headline CPI declined to 3%. However, core inflation still rose to 4.8% year over year, which shows we still have an inflation problem and is the reason that the Fed is still indicating at least 2 more rate hikes this year. The average US CPI inflation rate over the last 40 years is 2.8% about. If we can get the core inflation rate down to below 3%, and the Fed can declare victory, meaning no more rate hikes, after only destroying job openings and not actual jobs, that is the Fed's path to a softer landing. On the positive side, the jobs market remains strong, which is giving consumers the confidence to still spend. But given that we believe the market follows corporate earnings over the medium and longer term, future returns on stocks may be challenged in a higher for longer rate environment unless the earnings outlook improves. So we'll be watching earnings guidance for the second half of this year and for 2024 very closely during this earnings season. Thanks for joining. If you have any further questions, please reach out to a member of your client service team.